So Jim Cramer, I believe this morning, came out on CNBC and was blasting the Fed for basically being too restrictive on their monetary policy, meaning that, and I think he used the F word, saying, what the F are they doing? Basically, why aren't they lowering interest rates? So the next FOMC, a Federal Reserve meeting, is set for July 29th and 30th. And the rate decision, right, what's the Fed going to do, will be announced on July 30th. My take is, I believe, the odds are there's not going to be any kind of a rate cut. It's probably also even less likely that the rates are increased, but that nothing changes. As if you guys are paying attention to, the last several weeks, everyone's coming out blasting the Fed for not lowering rates like all the other countries are doing right now, loosening monetary policy beyond where it's at. And so I saw a couple articles today I thought were interesting to share with you. It has to do with, you've got people, people in the stock market, big commentators like Jim Cramer saying that rates need to be lowered. Now, I will say this, if rates are lowered, although I'm not saying I'm in favor of it, if rates are lowered, that will tend to light a fire probably under the housing market and possibly get it out of the rut it's in right now. It's also, of course, going to make it easier for the federal government to service its, $37 trillion of debt or whatever number we're up to now. So, but in terms of, these wealthy investors or wealthy stock market guys are coming out saying the Fed's got to lower rates, listen to this. Bear with me. So this is out of the Wolf Street yesterday. Fed's rates not restrictive for markets. Financial conditions ultra loose, mania's form, and here's the kicker: margin debt blows out. Says amid manias left and right, Goldman Sachs reported a 36% year-over-year spike in equity trading volume in quarter two. Charles Schwab reported a 38% year-over-year spike, and Morgan Stanley reported a 23% jump in equity trading year over year. So obviously investors are clamoring, reaching for yield, on their investment. If you lower rates, again, love to get your thoughts and comments, you lower rates, you even reduce the likelihood, or let's say you make it even more, crucial for investors to reach for yield, right, when rates are lower. So it says Exhibit A of loosey-goosey financial conditions. Margin debt blew out, spiking by 8.3% in May from April and by 9.4% in June from May to a record $1.01 trillion. It says in dollar terms, June was the biggest month-to-month spike ever at $87 billion. It says combined margin debt with meme stocks, and the author says it's magic. So another story I see today out of a publication called Wealth Advisor talks about this margin debt. If you guys are in the market, you understand what margin debt is, and margins. Basically, you are taking a loan from your brokerage account to be able to buy more shares of whatever stocks you're investing in. So let's say you buy $5,000 of stock and then you borrow $5,000 on margin from your brokerage firm. And that's great as long as the stock keeps going up, right? And you're paying and servicing the margin interest. But if the share prices fall precipitously, you guys have all heard the term margin calls and things can get ugly. So out of Wealth Advisor, same kind of statistics, but I thought was very interesting. Latest FINRA, F-I-N-R-A data, outstanding margin debt again hit $1.1 trillion in June, eclipsing the previous record of $937 billion set in February. That's 18% jump in just 2 months. Again, says that's raising red flags. It's reminiscent, it says, of the late 1990s tech bubble and the pandemic era retail trading boom. Deutsche Bank strategists are urging caution It says, in a research note dated July 24th, a team led by credit analyst Steve Caprio likened the recent rise to the speculative surges of past bubbles. 18% two-month increase in margin debt is among the fastest ever recorded, just behind 24.6% spike in December of 1999. And you guys know what followed that was the dot-com bubble and bust. And he says the 20.3% rise in May of 2007, and we saw what happened after that. You had, Lehman failure. You had, the whole market collapse. Says the level and pace of margin debt growth today that suggests that market sentiment is starting to run too hot. I did a video, I believe about a week ago, where I had shared with you the statistics on the PE ratios. And at what multiples these shares of stock are actually trading at right now. And that was, of course, some of the greatest disparity as well that we've had on record. It says the $1 trillion milestone in margin debt isn't just a headline, it's a temperature gauge on market sentiment. It says for wealth managers, it's a prompt to revisit asset allocation, reinforce investment discipline with clients, and prepare for possible shifts in market dynamics. Leverage can be a powerful tool in rising markets, but it can also accelerate losses when the tide turns. And usually, guys, if you follow this stuff, the tide turns usually pretty rapidly, and it's something usually that comes out of left field. That's what they call it the Black Swan, right? So you have investors that are calling for lower rates, okay, yet they're margining out, okay, at the greatest to the greatest extent, really, in the past several decades. So does that seem to you? Love to get your thoughts and comments. Does that seem like they're speaking out of kind of both sides of their mouth, right? But let me talk about asset allocation, because I saw an article today that feeds into this. That came out of Decrypt. And this is Ray Dalio. Again, we've talked about him before, from Bridgewater Associates. And what he's saying in terms of asset allocation is that people should be buying gold and Bitcoin. He's suggesting a 15% allocation of investor portfolios should now be in gold and Bitcoin amid increasing risks in bond and equity markets. Okay. Speaking at the Master Investor podcast, Dalio says the U.S. government is spending 40% more than it takes in, and it can't really cut its spending. He added it's accumulated a debt that's 6 times the amount of money it takes in, and in interest payments that are $1 trillion per year, which is half of its budget deficit. Dalio went on to explain that the U.S. government can pay its debts only by issuing more debt and by the central bank, Federal Reserve, printing the money. This has created, according to Dalio, a situation where markets may become increasingly spooked. And he suggests, okay, back to this rate cutting, discussion and fever that's going on right now. He says that a trigger for a big crash could be another significant round of quantitative easing, right? Which quantitative easing would be lowering rates, ramping up the money printing machines once again. Usually you don't hear that connection. Usually the markets feed off of QE, feed off of cheaper money, feed off of lower rates. And of course the markets, and including today, the famous Jim Cramer's out saying, Fed, what the F are you doing? Start cutting rates. So is it kind of like the markets, need to be careful what they're wishing for here? Because again, lower rates seems to me is going to result in investors even needing to reach for more yield, take on more risk, lever out more lines of credit, margin, etc. So for the folks that are pay attention to what's going on with markets. Again, today I think the Dow was off a little bit, but the S&P again squeaked out a little bit of a gain, and so did the NASDAQ. So again, markets are at all-time highs. Margin debt is at all-time highs. Okay, speculation is at all-time highs. Yet you have investors and TV personalities like Jim Cramer coming out and blasting the Fed, and I'll say this, including Trump blasting the Fed for maintaining restrictive or too restrictive monetary policy. So anyway, guys, appreciate you watching the videos. Thanks for the response. If you do like the content, please hit the like button for me. And if you're not subscribed to the channel, I would humbly ask that you hit that subscribe button, subscribe to the channel so you get notified as I drop new videos. Trying to do this pretty much every day. And appreciate you supporting the channel. As always, your thoughts and comments are welcome. And with that being said, I'll talk to you soon. Bye.